Watching. I'm Rahul Bhardwaj, the President and CEO of the Institute of Corporate Directors. As Canada and the world grapple with the implications of the COVID-19 pandemic, the ICD is producing a series of webinars and webcasts that focus on critical areas of governance that will help directors navigate the challenges in the weeks and months ahead. Today, we're discussing the economic crisis brought by COVID-19 and the unprecedented policy response from the Bank of Canada and other central banks. What do directors need to understand about the broader implications of these policies for their operations and for the broader economy? Well, there's no better person to discuss this with than my guest today, and that's Tiff Macklem. Tiff is the Dean of the Rotman School of Management at the University of Toronto and our partner in the Director's Education Program, as well as a director of Scotiabank. Prior to this, he served as a senior deputy governor of the Bank of Canada and played a leading role in ensuring stable financial systems worldwide through the Financial Stability Board. Welcome, Tiff.
Pleasure to be here.
Great. Let's start by talking about the central bank policy responses so far in this crisis. Can you explain a little bit about what the Bank of Canada has used to date and some of their implications?
Rahul, central banks have two big missions, and they have different tools for each mission. So first big mission is monetary policy, and that's really aimed at delivering, in Canada's case, inflation that's close to the 2% target. Many central banks, like the Fed, have a dual mandate. So in addition to the inflation target, they would have an objective to keep the economy at full employment. But whether you just have an inflation target or a dual mandate, effectively, they're pretty similar. You want to keep the economy operating close to capacity and inflation on target. And normally, the way the central bank does that is they raise and lower interest rates, and the policy rate is the overnight rate. It's one-day money. When they change that, that affects interest rates further out the yield curve, which are the rates that real people and real businesses actually borrow at. It also, in an open economy like Canada's, affects the exchange rate. And those things then affect spending and in turn inflation. So when the crisis first hit, the Bank of Canada, as well as other central banks, rapidly dropped their interest rate. But because rates were already pretty low, pretty soon they got down to zero. In Canada's case, pre-crisis, the policy rate was at 175. It was dropped in 3 steps of 50 basis points each to 25 basis points, which is effectively the lower bound. At that point, they obviously couldn't lower rates anymore, so they needed to move to what are known as unconventional monetary policies. And what they're doing is it's called quantitative easing, and what really that involves is it involves buying government bonds in large quantities out the yield curve. And when you buy something in large quantities, what it does is it drives the price up. So the price of those bonds is driven up, and that pushes the yields down. So you can think of quantitative easing as an alternative way of lowering interest rates further at the yield curve. They can't lower the policy rate anymore, but by buying bonds in large quantities, they can push the whole yield curve down. Central banks learned a lot about quantitative easing in the global financial crisis. And so globally, this has allowed them to move very quickly. They've come in, the Fed, the ECB, the Bank of England have come in very rapidly in large scale with big buying programs to really flatten the yield curve and get rates really right out the yield curve very low. And you're seeing a number of other countries, Canada, Australia, New Zealand, Sweden, have all embarked on quantitative easing. For Canada, it's the first time we've done this. QE works, but there are limits to it because the yield curve is already pretty low. It was already pretty low before the crisis, and it's not going to go below zero, or at least not very far below zero. The other limitation to monetary policy, which is very important in the current context, is that it's a very blunt instrument, and it can't plug specific income gaps that households or businesses are facing. And for both those reasons, we're going to have to rely a lot on fiscal policy. and governments around the world have announced massive fiscal expansion plans and emergency relief measures. Monetary policy, by holding interest rates across the yield curve very low, is making fiscal policy more effective. So let me now switch to the second critical role of central banks. And the second critical role is to provide liquidity against good collateral in times of crisis. There's a famous book by Walter Bagehot, written in 1873, called Lombard Street. And it has really the essential dictum of that central banks have been operating on ever since. And the dictum is effectively, to avert panic, central banks should lend early without limit to solvent firms against good collateral at a penalty rate. Mm-hmm. And the modern implementation of that is, I would say central banks have been pretty skinny on the penalty rate. And there's a good reason for that. They want the system to use these facilities to keep credit flowing. So the penalty rates have been not very penalizing. The other element in the modern implementation is that central banks are doing this in two ways. They are lending directly to banks. They're also implementing this through markets with various purchase programs to make sure that core funding markets keep functioning. Paper keeps rolling and the credit spreads don't become excessive. And these core funding markets are very important so that large companies can get direct access to funding, and so that banks can fund the loans that they're making. So in Canada's case, the Bank of Canada has expanded their repo program. They've introduced programs to buy BAs, bankers' acceptances, as well as commercial paper and some short-term provincial paper. By going into these markets and being kind of a buyer of last resort, they are making sure that this paper is rolling. These essential core funding markets are functioning well, and spreads don't become too wide. And again, because of what central banks learned in the global financial crisis, they've been able to come in very quickly at scale with considerable precision. And so although we're seeing huge swings in equity prices in the market, as the market really tries to find a new equilibrium price against the background of rapidly changing information, the core of the financial system actually is working quite a bit better than it did in 08, 09. There are certainly signs of stress, but it's not dysfunctional. And that's critical to keep funding, keep credit flowing. And let me just underline that this crisis in many ways is very different from the global financial crisis. This crisis is not a financial crisis, it's a pandemic. And the financial system actually this time can be part of the solution. It can be a shock absorber as opposed to the source of the problem. For that to work, banks need a lot of capital. Unfortunately, banks have built up very large capital buffers. In North America, something like $1.4 trillion of new capital have been built up in the last 10 years. They've also got much bigger liquidity buffers. Now's the time to use that capital. The other key part they need is funding. If they're going to defer mortgages, if they're going to loan to business and find lending solutions to consumers and business to help them get to the other side of this, they need to be able to fund those loans competitively. And that's why the Bank of Canada is coming in with a bunch of facilities to make sure that they can fund those loans and we can keep credit flowing.
So that's a great point to pick up, that this is fundamentally different than 08. And you've highlighted how the bank has gone a different route than they did in 08. But I'd be curious of your views around the implications of the staggering amounts of debt taken on by the federal government now, and what should boards be thinking about that?
Well, the good news is that Canada came into this in really quite good shape. Our economy was reasonably strong. Our financial system is resilient, and our debt levels, at least within the G7, they're the lowest. We have the lowest debt to GDP ratio in the G7. So Canada has the capacity to massively expand. And what I would stress is that, right now by necessity, we've imposed extraordinary restrictions on the economy. And so, you can't stimulate the economy and restrict it at the same time. So by necessity, the immediate actions of the government are focused very much on emergency relief. And I would actually give the government pretty high marks in terms of rolling out a whole series of programs to really help businesses and help individuals build a bridge to the other side of this. 4 months from now, many of those programs will start rolling off unless they're extended. And at that point, it's going to be important for the government to be thinking about more traditional forms of stimulus to help the economy ramp back up. Yes, there will be a big buildup of debt, but the best thing we can do is help the economy recover. That's going to be critical to all our livelihoods, and is also going to be important for the government's own fiscal situation.
Sure. So let's pick up on that a little bit. We're talking about debt. Let's talk about the other side of that, and that's the interest rate. So the Bank of Canada rate's effectively zero. And I'm not going to ask you what you think is going to happen next, but what are the implications for Canadian business if we actually went to a negative interest rate? And what else can central banks actually do in this space?
Well, there are certainly other things the Bank of Canada can do, but I won't pretend that there aren't some limitations on monetary policy. And as I already highlighted, that's an important reason why we need a big fiscal expansion. But what are the instruments at the disposal of the Bank of Canada? So in addition to interest rates, one instrument they used last time very effectively, it was actually a Canadian innovation, was extraordinary policy guidance. So not only did they lower the interest rate to effectively zero, they made a conditional commitment that it was going to stay at effectively zero for a year, or unless inflation started to go up. They haven't used that this time, and I think the reason is that rates were already really quite low, so they moved immediately to quantitative easing. But the two can certainly go together. Quantitative easing can be used to support and deliver on extraordinary policy guidance. The quantitative easing program can be scaled up. There's potential to move it up and move it down. Another sort of variant on quantitative easing is something called credit easing. And in fact, the Fed is currently credit easing. And what that involves is buying corporate bonds. So in the US, there is a program now where the Fed is buying investment grade corporate bonds. And what that does is, so quantitative easing pushes the government interest rates down. But what companies borrow at, of course, is a corporate rate, and there's a spread over the government rate. And so what credit easing does is it prevents the credit spreads from widening and pushes those in so that the effective rate that companies can borrow at is lower. The Fed is already doing that. That is something in the central bank toolkit. You mentioned the possibility of negative rates. Those have been used in Europe. They've been used in Japan. And that is certainly an option in North America. But my sense is there's not as much enthusiasm in North America for negative rates. And I think there's a few reasons for that. One is that I think the jury's still out about how effective they've been in Europe and Japan. And secondly, there's some limitations to how effective they can be. I mean, you can go negative, but you can't go very negative because people will just switch into cash. There's some cost to holding cash. That's why you can go a little bit negative, but it's not going to get you that much more room. And secondly, there is a risk that it weakens your banking system, because while it works okay for wholesale funding, it's very hard to explain to depositors why their deposit in their bank account is shrinking every month, even though they're not spending any money. And so, and deposits are how banks fund loans. So they can't have a negative interest rate on the deposits, either it's going to be hard for them to pass that negative interest rate on to the loans they're making, or if they do, their profitability will be reduced, and ultimately that means they'll be accreting less capital, and so they're again less able to make more loans. So that one is a possibility, but as I said, I don't see as much enthusiasm for negative rates going forward.
And Tiff, you'd mentioned Europe and Japan, and rightfully you've sort of brought in the point that we've taken this global. So it's a global crisis with global implications. How important is international coordination in addressing something like this? And how does that actually happen?
So, one of the beauties of having your own currency is that you get to run monetary policy geared to what you need to do for your country. And the exchange rates between the countries absorb the difference. And certainly for Canada, I think that is a real benefit. Our economy is different than the US economy. We're more commodity based. We've seen a big collapse in the price of oil. That's a big negative shock for Canada. And you can see the value of our dollar has come down relative to the US, which provides some sort of offset to this oil shock, and is helpful for the Canadian economy. Certainly in certain circumstances, coordination can be very valuable, and a crisis is certainly a time when coordination can be very helpful. And you saw this in the global financial crisis. You saw this at the beginning of this crisis, where the G7 got together and central banks signaled that they would all be cutting rates. And in the space of a week or two, you saw really a coordinated cut across the G7 in interest rates. And why is that valuable? Well, if countries do it all very separately, the market focus shifts on, which they just cut interest rates the most, they must have the biggest problem. Whereas when countries do it together, it's like, okay, it's more of a mention. It's more like a plan, and it's more a message of confidence to the market that we're working together. The other, it's clear that central banks are all learning from each other. They're trying different variations on quantitative easing and credit easing, and experimenting with different tools to support credit markets. Central banks do talk amongst themselves very frequently. A lot of that happens through the Bank for International Settlements in Basel. Traditionally, there'd be a lot of trips to Basel. Obviously now these meetings must be happening remotely. But there is certainly a strong professional bond between the central bankers, and a high degree of willingness to share information and learn from each other.
Great. So I'm going to ask you to switch your hats on and back to your dean's hat and your director's hat for a moment as well. And I'm wondering, do you have any advice for business leaders on how they can best use this crisis to innovate, reevaluate their business models, to build stronger organizations in the post-pandemic world?
Well, I think when you're faced with a crisis, the first thing you need to do is you really need to shorten your horizon. This is not a time for 5-year strategic plans. You need to focus very immediately on your cash flow. You need to focus very immediately on your employees. You need to focus very immediately on your customers. I think it's very important that hoping for the best is not a strategy. You do have to really map out some scenarios and look at your cash, look at your horizons on a number of scenarios, and don't wait too late to take action. I've seen too many times companies kind of hope for the best, and then they have to go to market. It's too late, and they're in big trouble. I do think directors need to be careful not to be overwhelming management with too many questions. Management is very busy. There are probably more frequent board meetings, but it's important to keep them precise and focused, and really focused on immediate priorities. I do think directors can help management think about what might be coming next. When I think of the current context, I think what's coming next is probably about a month from now, governments will start taking restrictions on, gradually removing restrictions on the economy, and we're going to go back to work. But it's not just going to be a return to normal. This virus is going to be with us for some time, and so how do we work effectively in that environment? How do we serve our customers effectively in that environment? How do we work around our disrupted supply chains? And maybe what opportunities are there to pivot to new sources of consumer demand? The other thing I would say is that the reality is there's a lot of uncertainty, and it's important to think about strategies that are robust to a number of possible outcomes. It's probably not the time to put bet on, okay, I know exactly where it's going, and we're going to put all our eggs in this one basket. Think about things that that would work in a variety of scenarios. There's a little bit of advice, but it's not going to be an easy job.
No, not at all. Some very wise counsel. And thank you for joining us today, Tiff. Appreciate it a great deal. And thank you, everyone, for tuning in. Please look out for new installments of this series every week as we navigate this challenge together. Keep well, and bye for now.
Thank you, Rahul. Thank you all.